Corporate earnings play a significant role in influencing stock prices, reflecting the financial health and performance of a company. Here's how corporate earnings impact stock prices. Earnings expectations. Market reaction. Stock prices often react strongly to whether a company meets, exceeds, or falls short of analysts' earnings expectations. If a company reports higher than expected earnings, it may lead to a positive stock price reaction as investors perceive the company's performance favorably. Missed expectations. Conversely, if earnings fall below market expectations, it can result in a negative stock price reaction as investors may interpret weaker earnings as a sign of poor financial health or operational challenges. Profitability signals. Indicator of profitability. Earnings reflect the company's ability to generate profits from its operations. Strong earnings growth or consistent profitability signals to investors that the company is efficiently managing costs, maximizing revenues, and delivering value to shareholders. Long-term perspective. Investors often consider earnings trends over multiple quarters or years to assess the company's financial stability and growth potential. Sustainable earnings growth can support long-term stock price appreciation. Valuation metrics. P/E ratio. Price to earnings (P/E) ratio is a key valuation metric used by investors to assess whether a stock is undervalued or overvalued relative to its earnings. Higher earnings can lead to a lower P/E ratio, indicating that the stock may be attractively priced compared to its earnings potential. Earnings growth rate. Investors evaluate the company's earnings growth rate to determine future earnings potential and estimate the intrinsic value of the stock. Rapid earnings growth often correlates with higher stock prices. Investor sentiment. Market confidence. Positive earnings reports can enhance investor confidence in the company's management, business strategy, and operational execution. This confidence may attract new investors and support higher stock prices. Risk perception. Poor earnings performance or unexpected declines in earnings can raise concerns among investors about the company's financial health and operational risks, potentially leading to selling pressure and lower stock prices. Dividends and capital allocation. Dividend payments. Companies with strong earnings may have sufficient cash flows to pay dividends to shareholders. Consistent dividend payments or increases can attract income-seeking investors and contribute to higher stock prices. Investment in growth. Companies with robust earnings may reinvest profits into business expansion, research and development, or acquisitions, driving future growth prospects and enhancing stock price appreciation. Market dynamics and sector trends. Sector performance. Earnings reports often influence broader sector trends and investor sentiment towards specific industries. Strong earnings from leading companies within a sector can lift overall sector performance and contribute to sector-wide stock price movements. Forward guidance. Future expectations. Alongside earnings announcements, companies provide forward guidance on future earnings expectations, revenue forecasts, and strategic initiatives. Positive guidance can boost investor confidence and support bullish sentiment towards the stock. In summary, corporate earnings are a critical driver of stock prices, impacting investor sentiment, valuation metrics, dividend policies, and market dynamics. By analyzing earnings reports and understanding their implications, investors can make informed decisions and position themselves to capitalize on opportunities in the stock market.